and welcome to The Upside. I'm Nicole Correale. When it comes to learning, there's truly no better way to deepen your understanding than by asking questions, the ones that spark curiosity and make you think twice. And in the world of investing in financial markets, there's always something to ask. Sometimes it feels like the markets create new questions just to keep us humble. Today's episode is all about you. I'm bringing your biggest questions, the ones that keep you up at night, the ones that make you go, huh, straight to our next guest. Joining me for the launch of a brand new series called In the Chat with Denise Chisholm is the one and only Denise Chisholm, Fidelity Director of Quantitative Market Strategy. Welcome, Denise. It's always a pleasure to see you.
Hey, Nicole, it is great to be here. I love the Q&A segments.
Thank you. I agree. Before we jump in, a quick note to our viewers. If you have a question for Denise, send us an email at upside@fidelity.ca or drop it in the comments below. And your question just might be featured in a future episode. So Denise, hit us with your 1-minute rewind. Which economic data report or reports defined 2025?
I think it was inflation. And in some ways it was, I've heard it called, and I won't quote it myself, the dog that didn't bark. I think that there were many strategists and people who watched the stock market that thought that inflation was either going to accelerate or to be the most influential variable. And in fact, that turned out to just not be the case. Despite the fact that tariffs made the prices of some goods go up, it actually saw that you didn't negate the descending trend or the deceleration in inflation. So it wasn't meaningfully different than the Fed expected or many market prognosticators expected either, which meant that it wasn't the key driver to the markets, which meant that the real key driver was the typical key driver of earnings growth, which was stronger than people expected, which continued to drive the secular bull market forward.
Let me dive right into our first question from our first viewer. This is from a viewer in Duncan, BC, who was asking, "Hi, Denise. Can you explain the difference in views you and Urian Timmer seem to have on where we are in a bull market cycle?" He's saying we are in the later stages of this bull market, whereas you are saying we are in the early stages. Thoughts?
Yeah, I think it's the best part of market analysis, which is there is the science that we talk about, right? I have a data-driven process, but there is a whole lot of art to it as well. So here's some of the math behind the things that I've heard Urian say and how I evaluate it from a quantitative perspective. I have heard him talk about two former secular bull markets, 1982 to 2000. The interesting part is you have to define a secular bull market. And really, when you think about it, ours right now that we're saying started in 2009 looked through some pretty significant downtrends as well. I mean, the COVID downtrend was 35%, and 2022 was almost 30% as well. So we're saying that is normal variation within a secular bull market. So that's the art. So what variation are you willing to look through historically? If you say that 1982 was the low and 2000 was the high, we'll define that as a secular bull market. Well, then that would mean that we are in fact late stages for this push of the secular bull market. But if you look back in history and say, actually, the low in 1974 was much lower than the low in 1982. And we're going to look through those two corrections. I think one was 20%, one was 25%, and calls 1974 the low. And all of a sudden you start to tack 5 to 7 years onto the end of this, what could be this secular bull market, saying, well, maybe in fact we're not late stages. If you're really interested on the details of how another way you could look at it, we actually produced a white paper, myself, Roy Justice, and Darren Chabot, looking at the prior two secular bull markets and saying, if you're willing to look through that kind of volatility, then maybe if we stopped now, that would actually be the historical anomaly. So again, this is back to the art and science. I don't think that there is any one right way to look at the market, which is why we present to you all of the data so that you can hear all of the views and make the decision that makes the most sense to you.
Our second question is from a viewer in Kelowna, British Columbia. You have frequently critiqued the Federal Reserve for being late because they rely on heavily revised government data, such as non-farm payrolls. However, in 2026, we are seeing a massive divergence between traditional surveys and real-time private sector data. If the signal shift itself is becoming permanently fragmented due to declining survey participation, how does your quantitative model adjust for a future where historical data points, like the NFIB survey or initial jobs?
Yeah, so let's take that in two parts. One, the data dependency in the Fed relative to history, and then two, whether or not it's predictive of the overall equity market. The interesting thing is, I've said from a factual perspective, I would imagine that it is tricky being data dependent on a very heavily revised number. I suspect that there are more things that go into the Federal Reserve's forecast than just data dependency on non farm payrolls. So it doesn't necessarily mean that they're making the wrong decision or the policy mistake. Now, that said, the interesting part from my perspective in terms of history with the Fed being, quote, late that you said, is that most of the time in history, that actually has been the case, meaning that it's not particularly anomalous. And I say this because here is the data. When you look at real interest rates, which is kind of what the Federal Reserve is targeting to manage the economy, what you see is a clear pattern. The higher real interest rates are, the more likely real GDP is to be higher the year later, and even the second year later, which means, and there are a lot of sort of dependencies in the data, but one of the points that this means is the Fed more often than not, which is not to say every time, follows the cycle rather than creates the cycle. So, to the extent that your point is, well, being data dependent creates a potential for them being late, which creates a potential for them having a policy error, there is a difference between being late and making a policy error. And right now, late looks to me, from a definitional perspective, to be what most likely they have been, which is the better part of history. Which leads me to the second point in your question, which is to say, well, wait a minute, what if non farm payrolls, we're not really getting the surveys, and then the NFIB survey doesn't have the respondents? Do we really know what is going on in the overall job market? And here is the interesting twist. The question is, does that matter if we even knew for the stock market? And that's the data that is really the interesting twist. When you see low payroll growth, and I think I'll put out a note on this, low payroll growth or the worst negative revisions, what you find is that more often than not, over the next 12 months, you actually have better than expected stock market returns, meaning that what usually happens is the inverse of the relationship that you think. Why? Because whatever it is that you're afraid of, usually stocks have already discounted that low payroll growth. And that's actually what we've seen overall in 2025 when we saw that almost bear market, was with the tariff tantrum, the stock market saying, hey, I think that there's going to be a problem in the job market. And now we are seeing that exact case play out, which is there's a problem in the job market. So the interesting part about stocks is that more often than not, they get it right quicker than the economic data. So while in some ways your question asks, shouldn't we focus on the economic data? I think most of the time in history, you see that that is actually backward looking.
Shifting gears here, our next question is regarding sectors. From a viewer in Alberta, do you think that cyclicals might outperform tech in the short term? And what is your take on commodities as a diversification option?
So if you define cyclicals as economically sensitive sectors like consumer discretionary and financials, I would say yes. I think in the short term, or maybe even in the medium term I'll define as a year, that they could actually beat the S&P technology sector. So I do think that technology is an outperformer, but it wouldn't be shocking if it only outperformed by about, let's call it 300 to 400 basis points, not the 1,100 basis points that we saw last year, and that leaves the ability for other sectors to outperform more. That would be not surprising, that technology ends up sort of being in the muddy middle and there's other leadership. So what would be surprising to me is if technology broadly underperformed or dramatically underperformed, given the strength of the fundamentals that we're approaching 2026 with. So yes, if you define cyclicals as financials and consumer discretionary. On commodities, it's interesting. I was actually just looking at the data when I saw your question. So what you do see is there have been a lot of times in history with the data going back to the 1950s, if I'm looking at the overall CRB, where you have seen commodities and equities diverge substantially, meaning equities going down 16%, but commodities actually going up by about 11 or 12%. The issue with commodities as a true diversifier is that slice only happens about 15% of the time in history. So once every 7 years or so. The bulk of the time, commodities and equities usually go up together. and equities go up more than commodities, which is when you look over the long term, you'll see that equities return about almost 10% with a total return, and commodities about 2.5%. So that diversifier option does happen, but it happens less frequently than you think. So if all of diversification is about, look, you're going to have to make a trade-off. Yes, you will get lower risk-adjusted returns or better risk-adjusted returns during that time. You might have to trade off some of that upside to be able to capture that relative risk. I think the other question sort of implicit in it is it different this time if inflation stays higher? Maybe commodities are a better diversifier. And again, just based on the numbers, you would have to see substantially higher inflation, above 5%, to get that to be more true, meaning that commodities provide potentially even better upside returns than equities. So are they a diversifier? Yes, occasionally. But if you're still looking over the long term, they tend to produce lower returns than equities. And I think that that's important for investors to understand as well.
That's very important. And lately, you've been speaking a lot about the financial sector. And this question, or this viewer from Burnaby, BC, wants to know, are there financial subsectors that are more interesting to you than others?
Yes, in fact, the ones that have better fundamentals. And I would say that that is capital markets and brokers as the subclasses, as opposed to banks or insurance. And banks or insurance certainly have the valuation risk reward. But when you look at the, let's call it bang for your buck, a valuation per unit of ROE, or for secular trends in terms of upside in earnings or upside in either margins or returns, depending on which financial that you're looking at, I see better fundamental trends in capital markets and brokers, and they are more tied to, let's get back to the first question, the secular bull market that I think remains in place in 2026.
So until we speak again, what's top of mind with you that you think investors should keep an eye on in the next month?
Yeah, in the next month, well, I usually say credit spreads, but let's give you something else to look at in the next month, which I think is oil prices. So as much as we are all focused on the tax rebates in the US coming to the US consumer to be supportive of consumer spending, it's worth thinking about oil prices in the exact same context. Because back in 2025, one of the reasons why tariffs weren't as corrosive on the US consumer is because there was a very large offset of lower oil prices, which was like a $250 billion tax cut to the US consumer, which was a 1% tailwind. So despite the geopolitical risk we're seeing, we haven't seen much upside in oil prices, which might mean to the extent that geopolitical crises get resolved or uncertainty actually declines, that oil prices fall as well, and there is yet another tailwind for the US consumer. So that's why you should be keeping your eye on oil prices.
Well, thank you, Denise. It is always a pleasure to chat with you, and this Q&A session was informative and helpful, and I hope, I think you answered these questions perfectly, so I hope our viewers who sent in their questions walk away feeling, that they have their question answered. So thank you so much. And thank you for joining me on The Upside. If you have a question for Denise, email us at upside@fidelity.ca, and it might just be answered in our next episode. For more investor content, be sure to subscribe to our YouTube page to never miss an episode and sign up for our newsletter. And remember, working with a financial advisor is the best investment you can make on your financial journey. For The Upside, I'm Nicole Correale.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.